Chapter 8, Going Forward. Although the last, not least. William Shakespeare, King Lear. Financial statements tell stories. They tell stories about the economic and business realities of firms. Anyone can read these stories, but we do need to be careful and not take everything at face value. Financial statements need to be carefully and skillfully analysed. We also need to read the stories provided by financial statements in the context of other sources of information. This study guide has provided you with the discounted cash flow and economic profit approaches to analysing financial statements and to valuing businesses. There are other approaches, and they can all have a place in the armoury of an accomplished analyst. Most importantly, this study guide has provided you with a way of thinking about financial statement analysis. This can be a foundation on which you can develop and build your own understanding of how to use financial statements to help you connect to the economic and business realities of firms. Financial statement analysis often involves looking at ratios, comparing two or more elements of the financial statements with each other, or with other information such as listed share prices. This can help to bring into sharp focus for us relationships and help us identify key economic and business realities. Analysis involves us breaking things into bits to better understand what is going on. We have seen that breaking things into bits and looking for key relationships is what financial statement analysis is all about. In this chapter, we will think about how we can use the good thinking and ideas of accounting and finance to help us change the way we view business reality, to make personal sense out of this reality in the same way as an accounting or finance professional might engage with, understand, and make personal sense out of the messy realities of business. 8.1. 2 frameworks. This study guide has given you 2 frameworks, or ways of thinking, for using financial ratios to understand the value generation activities of a firm and to value the equity of a firm. These frameworks, these ways of sense-making, of understanding, of putting things together in our minds, can help us understand what a firm's financial ratios are telling us. It is one thing to be able to calculate a whole lot of ratios, but a totally different thing to make sense of them. In Appendix 3, there are web addresses that can link you to common financial ratios that people often calculate to help them understand what is going on in a firm. But how do we make sense of all these types of ratios we could calculate? What do they tell us? How do we read these messages from financial ratios that express certain relationships between 2 or more aspects or measures of a firm? The discounted cash flow and economic profit frameworks are 2 ways of making sense of various financial ratios of firms. They are 2 ways of using the financial statements of a firm to quantify our qualitative assessments of the economic and business realities of a firm. The reason we want to quantify our assessments about a firm is that economic transactions occur at a price expressed in dollars. To operate in capital markets, we need to be able to summarise our opinions, assessments and information about a firm's economic and business realities into a single dollar figure. There is much about financial statement analysis which we have not covered in this study guide, and there are a range of economic decisions many stakeholders in a firm may wish to make based on an analysis of a firm's financial statements and other information. These include management making capital investment decisions within a firm, bankers making decisions about debt investments in a firm, competitors assessing the financial position and likely future competitive strategy of a firm, regulators assessing whether a firm is using its market power to unfairly extract economic rents, business suppliers and customers wishing to assess the financial stability of a firm, employees wanting to know if they are fairly sharing in the value creation activities of a firm, and community groups wanting to understand the impact of a firm's activities on areas of wide social concern, for example, the environment. There is much more that a firm can contribute to its stakeholders than providing value to its equity investors. There is value it can add to customers, employees, suppliers, and the community more generally. Successful firms generally add significant value to a range of stakeholders, and to provide value to equity investors usually requires businesses to provide value to many other stakeholders as well. The frameworks we have covered in this study guide focus on one aspect of what adds value, that is, value to the equity investors of a firm. Theory about value. We've looked at the theory of how to measure what adds value. There are several ways of thinking about how to measure what adds value. We saw that finance theory tells us that the value of an asset is the present value of the cash flows we can expect from it. Dividends are the cash flows an equity investor can expect from their equity investment. The value of an equity interest in a firm would be the present value of the expected future dividends, the discounted dividend DD approach. Based on this thinking, we could value the equity in a firm by forecasting its future dividends to eternity and then discounting them to a present value. In reality, of course, firms do not have an infinite life. They are either liquidated or taken over eventually. This means their equity investors will at some future time receive a final effective dividend on their equity interest. The dividend discount model forms the theoretical basis for many approaches to financial statement analysis and fundamental analysis, to knowing what adds value for equity investors. If we have a comprehensive income approach to the firm's accounting in its financial statements, as largely underlies international financial reporting standards, we can re-express the dividend discount model as our economic profit model. Value of equity equals book value of equity plus the present value of abnormal earnings. We have seen in Chapter 6 that if a firm's financial activities do not materially add value, the economic profit model can be restated as value of equity equals book value plus the present value of abnormal operating income. We have seen we can express the value of equity using a dividend discount model, that is, as the present value of expected future dividends, using a discounted cash flow model, that is, as the present value of expected future cash flows, and using an economic profit model, that is, the book value of equity plus the present value of expected future abnormal operating income. The theory or thinking behind each of these approaches is the same. They are all based on the notion that the value of equity in a firm is based on the present value of future payoffs to equity investors to eternity. The dividend discount model uses dividends as the measure of payoffs to equity investors. The discounted cash flow DCF model uses the present value of cash flows, and the economic profit model uses the current book value of equity and abnormal operating income as the measure of payoffs to equity investors. In the long term, theoretically they will be the same. All should give the same measures of value for equity because the present value of dividends, the present value of cash flows, and the current book value of equity plus the present value of abnormal operating income will effectively correspond in the long term. The discounted cash flow and economic profit approaches represent powerful frameworks or ways of thinking about how a firm adds value to its equity investors. The extent to which a firm is expected to be able in the future to generate cash flow or abnormal operating income, that is, returns more than the cost of the capital the firm is using to generate these returns, will drive the extent to which the value of a firm exceeds the book value of its equity. Another way of thinking about the economic profit framework is that the value of a firm's equity is based on the book value of the net assets the firm has employed in its business, that is, the book value of its equity, plus the present value of any upside from the expected or perceived growth options the firm has for the future. This is calculated as the abnormal or extra operating income after tax the firm is expected to generate in the future more than its cost of capital. This could, of course, work in reverse, where a firm is expected to earn less than its cost of capital. As we have seen, a common valuation approach is the discounted cash flow DCF approach. This is an approach favoured in finance subjects and in finance theory and by many analysts and finance professionals. This is also based on the dividend discount approach, where future expected cash flows are substituted for dividends. The dividend discount, discounted cash flow, and economic profit approaches are all theoretically sound approaches to valuing a firm. They are each based on the same concepts or ideas about what makes an equity investment in a firm valuable. They each provide a framework to help us connect our analysis of a firm's financial statements and our expectations about the economic and business realities of a firm to measures of value of a firm. Many practitioners and analysts in the world's capital markets that subscribe to the value of fundamental analysis of firms also subscribe to the theory we have been discussing. However, it is generally accepted that the dividend discount approach is almost impossible to implement in practice due to the difficulty of making long-term forecasts of dividends. Forecasting dividends involves forecasting a firm's dividend policy, which is a decision made by a firm's management and directors and can be influenced by a range of factors in addition to the expected future earnings or cash flows of a firm. Also, dividends are a transfer of value between a firm and its equity investors and are not a measure of the creation of value, which is what we are fundamentally interested in connecting to and understanding. If you ask most practitioners and analysts, they would say they do not value a firm based on its discounted dividends, but many would say they use a form of the discounted cash flow or economic profit approaches. However, as with many things in life, what we say we do can sometimes be rather different to what we actually do. Both the discounted cash flow and economic profit approaches impose significant challenges on those seeking to use them in practice. The key difficulty is the need to prepare detailed forecasts for a variety of aspects of a firm, including profitability, growth rates, and the cost of capital for several years, say 3 to 5 years, into the future. This is not an easy task. Many would argue that it is not possible to make these forecasts, or at least not practicable based on cost-benefit considerations of the amount of time and energy required to make these forecasts and the actual benefit to be derived from having made them. For these reasons, some would argue that the discounted cash flow and economic profit approaches are, like the dividend discount approach, not practicable to implement in practice in many cases. Instead, they would argue, we are better to focus on how others might value or view a firm. If indeed the average period equity investors hold their investments in listed companies is about 18 months, then it might seem to make pragmatic sense to attempt to predict what we expect other equity investors might be prepared to pay in 18 months' time, rather than attempt to make an assessment of its intrinsic fundamental value and then be prepared to wait it out until the market agrees with our assessment. Some would argue that given so many factors are required to be forecast in a discounted cash flow or economic profit valuation, such as various profit margins, asset turnovers, net capital investment, over a lengthy period, say at least 3 to 5 years, not even a firm's management, with all its intimate knowledge of their firm, is able to make such forecasts, let alone those of us standing outside a firm with so much less information. Indeed, some would argue a lot of factors we need to make detailed forecasts must be effectively guessed or are questions of judgment and intuition. They would suggest that seeking to make explicit judgments about these factors and then including them in, say, a long-term forecast of a firm's abnormal operating income or economic profit is a questionable activity. Surely, they would argue, it is better to face up to this difficulty, to not delude ourselves into thinking it is otherwise, and instead to simply bundle up these judgments into the estimation of just one item, a firm's price multiple, usually a price to earnings PE multiple. This is tantamount to saying there is no workable theory in financial statement analysis that can direct the practice of financial statement analysis. If such is the case, we need to revert to implicit smoke and mirrors and circular reasoning that is based essentially on speculative outguessing of other people speculatively outguessing what we may be guessing, and so on. Indeed, we do find our capital markets from time to time go through speculative bubbles with no theory firmly grounding participants' views of value, independent of sentiment and guessing what actions other market participants might do in the future and how share prices might move in the future. It is difficult to forecast a firm's abnormal operating income or cash flow. It takes time, energy, and skill. It may well be that some analysts in our capital markets lack one or more of these attributes. Indeed, analysts in listed share markets often only publish short-term, that is 1-year forecasts of earnings, and only a small proportion appear to include a long-term growth forecast for earnings, that is an annual expected growth rate in earnings, for say a 3 to 5 year period. So how do capital market participants form their view of the value of equity in firms? Many do this by estimating next year's earnings and applying a multiple to these earnings based on a consideration of the price earnings multiples of comparable firms. 8.2. Price multiples. Price multiples are widely used in practice to value a firm, and for many forms at least part of the basis of knowing what adds value. One reason for their widespread popularity is they seem to be practical to use. They seem to work relatively easily and, importantly, can be readily accepted by others as a basis for value. We are often able to use price multiples to persuade people about what equity interests in firms are worth. There is no need to produce detailed forecasts of earnings for many years into the future. Instead, we simply select the item of interest, such as earnings, book value of equity, net tangible assets, sales or cash flows, calculate price multiples for comparable listed firms based on their listed share prices, and then use these multiples of comparable firms to value a firm. Others do the work. In this way, we rely on the share market to do the work for us, to carry out the difficult task of forecasting the future profitability, growth rates, and cost of capital for our comparable firms. We then simply assume or guess this is appropriate to the firm we are analysing. We can also look at the multiples at which comparable firms may have been purchased or sold recently, for example based on the price paid or offered on a listed takeover bid, or the multiples at which some comparable private companies may have been purchased recently, to the extent we are able to gain this information. Almost every day in the financial media, we can see examples of this approach. It certainly seems to make sense. Essentially, the value of a firm, or what it is worth, is simply what someone is likely to pay us for it. The best and easiest way to find this out is to look at what people are paying for comparable firms. After all, why should the value of our firm be different to what people are prepared to pay for similar firms? Most people are familiar with such thinking in residential real estate markets. We fly into Perth in Western Australia for the first time and want to buy a 3-bedroom house in the suburb of Shenton Park in which to live. The vendor of one house is asking $1.2 million for their house. How do we know if this is a reasonable or fair price? After all, the vendor of the house will want as much as possible for it, and we will want to pay as little as possible. What do? Well, we get a list of the prices of all the comparable 3-bedroom homes that have sold nearby recently. They will all be slightly different to the house we're considering buying. Some might be on a busier road, some might have a larger or smaller garden, some might have a double garage and others a single garage, or be in better or worse condition, or be in a better street. All the comparable houses will be slightly different. But they will all be sufficiently like the house we're thinking of buying to help give us an idea about how much we will need to pay for the house. That is also how the thinking goes with looking at comparables of a firm to determine its value. Such an approach is not independently assessing the value of a firm, but is rather assessing its likely price. Price is what you pay. Value is what you get. They are not always the same thing, although they sometimes may be. If we want to buy a 3-bedroom home in Shenton Park in Perth, we will usually need to meet the market. Both the vendor and the purchaser of the home will look at the price at which comparable homes have sold in the area recently, and this will help to set the range of prices within which negotiations for the purchase of the home will take place. If everyone in the market adopts this approach, then that is how houses will be priced, and we can rely on it. However, the value to you of a home that we intend to live in ourselves is difficult to put into monetary terms, to put a dollar value on it, as it is about the benefit or consumption we will get from living in the home. This is difficult to put into precise dollar terms. The maximum we could reasonably pay for a home is easier to put a dollar figure on. It is the amount of capital we have to purchase a house plus the amount we can reasonably borrow from a bank based on our current and expected income levels and current and expected interest rates. How much we might pay for a house is easier to determine than what it is worth. By looking at recent sales of comparable properties, we have essentially left it to others to determine value, what it is worth to us. Indeed, we could expect that those who bought and sold the comparable properties did the same things as us, simply looked at recent sale prices of comparable properties. If we are looking to purchase a home as an investment property, it is easier to determine its value to us in dollar terms. We can estimate the rent we are likely to receive, the expected outgoings and expenses, maintenance, council rates and so forth, and calculate the net rental yield, the rent after expenses, divided by the asking price for the property. We can also think about the expected capital gain on the property by forecasting possible house prices in the future based on economic and other forecasted data, and consider whether the return on investment is enough. In this way, we can compare our view of value to the price in the market. The use of comparables in valuing firms seems pragmatic and practical, and is indeed widely used. However, such an approach is not grounded in any theory about the value of a firm. It is not grounded in a fundamental analysis or assessment of the economic and business realities of a firm. It is rather grounded in other people's assessments, who may in turn be relying on other people's assessments, and so on, in a type of round robin, if not indeed in a type of pass the parcel game. There is a disengagement or distance from, rather than engagement with, the economic and business realities of firms. By relying on comparable price multiples, we are not using a firm's financial statements to personally connect to reality. Rather, we are using them and a firm's share price as a type of proxy or stand-in for reality. We are keeping well away from the swampy lowland, messiness and confusion of a firm's actual business activities in the past, present and future. Further, the use of comparables has its own difficulties to implement in practice. Difficulties in identifying comparable firms that are sufficiently like our firm, and then difficulties in analysing what is driving the multiple for the comparable firms, and then for the firm we are analysing. In my opinion, the use of comparables in practice suffers from greater implementation difficulties than does the use of either the discounted cash flow or economic profit approaches. This is because the use of comparables requires us to understand the economic and business drivers of each comparable firm and to assess how these might differ to those of our firm, essentially requiring us to analyse not only the firm we're looking at, but each of its comparable firms as well. This is a significant task if we are to attempt to do it properly. The use of comparables is of value as a market check on the result of our own analysis of the value of a firm, in the same way as the firm's current listed share price, if the company was listed, provides such a reality check. If the firm we are analysing is a private firm that is not listed, then the only way to compare our estimate of value with the current market's assessment is by using comparables. Also, I would suggest comparable price multiples should be calculated on an enterprise or unlevered basis to avoid the effect of differences in leverage between comparable firms and the firm we are valuing. Take a shortcut rather than comparables. In my view, in practice, we are better to simplify the discounted cash flow and economic profit approaches to valuing a firm rather than seeking to use comparables to simplify the valuation task for us. This is because the discounted cash flow and economic profit approaches are theoretically sound and based on us independently forming our own view of the value of a firm based on our own connection to and assessment of the economic and business realities of a firm. This is fundamental analysis, as discussed in Chapter 1. The real issue here is one of philosophy or ways of thinking about business reality. In valuing a firm, am I seeking to determine its intrinsic value independently of what Mr. Market thinks? Or in other words, doing fundamental analysis? Or am I seeking to predict its future share price by assessing how the share market values comparable firms? It is part of the philosophy or thinking of this study guide that it is not the role of the analyst to predict share prices. Rather, the role of the analyst is to assess value and to simply assume that the market value of the firm will reflect this value in the future. That is, if their assessment of value based on their expectations of the economic and business realities of a firm proves to be correct. The question for you is, what do you think? You get to choose what philosophy you prefer. It is a good time to think about this. Whatever you decide, you will not be lonely. There are many people who hold a range of opinions and views on this issue. Criticising the practical use of comparables, as well as its lack of theoretical base or connection to intrinsic value, does nothing to address the significant challenges to implementing the discounted cash flow and economic profit approaches. In the following discussion, we will focus on the economic profit approach, but the same sort of issues would apply to the discounted cash flow approach. One way to simplify the economic profit approach without abandoning its theoretical base is to throw up our hands in the air and say it's simply not possible to forecast a firm's abnormal operating income. Full stop. Impossible. This approach is to assume the abnormal operating income of a firm follows a random walk. The firm's abnormal operating income will walk into the future, but it is anyone's guess where it will walk, to the left or the right or up or down. It's a bit like ballroom dancing with a partner who could step anywhere at any time. It is impossible to predict where they might step to next. Dancing with such a partner is not likely to lead to a great tango. However, given we do not know where they are likely to step next, our best guess of where they might go next is where they are standing right now. This would be the closest point to where they are going to step to next, compared on average to anywhere else we could guess. This is a random walk. In such a situation where we have no idea how to forecast a firm's abnormal operating income, our best guess about a firm's expected future abnormal operating income would be its current abnormal operating income. This could be expressed as follows. Forecast abnormal operating income in year 1 equals abnormal operating income in year 0. Also, forecast abnormal operating income in year 2 equals forecast abnormal operating income in year 1, etc. This is another way of saying that the current economic and business drivers of a firm's abnormal operating income are expected to continue as they are forever, and that any changes to these economic and business drivers in the future are completely unpredictable. Our forecast of abnormal operating income for all periods into the future, that is to eternity, would be the current abnormal operating income. That is abnormal operating income little zero. Such an approach greatly simplifies our economic profit model, since the present value of abnormal operating income would simply be a perpetuity. Our enterprise economic profit model would be value of equity equals the book value of equity plus the present value of abnormal operating income, which equals the book value of equity plus abnormal operating income in year zero divided by the weighted average cost of capital minus 1. Our value of equity would be the book value of equity plus current abnormal operating income divided by the cost of capital for operations. We could also include in our random walk some allowance for drift. For example, we may not know where our dance partner may put their next step in the tango, but we may expect that we will drift progressively to one side of the dance floor over time as our partner is left-handed and has some tendency over time to favour their left foot. In the context of our economic profit model, this would mean we could include growth, for example, either by a constant growth rate each year, for example 4%, or by a constant amount each year, for example $1 million. It would still be random, like the situation that we would not know where our dance partner will step to next. But over time, we can expect this drift of our random dance partner to occur. For example, if we were to assume a constant growth rate in abnormal operating income, we could express our economic profit model as value of equity equals book value of equity plus abnormal operating income in year zero divided by weighted average cost of capital minus G, where G is the expected growth rate in abnormal operating income. You should note, however, that we still need to assess the weighted average cost of capital, WACC, the cost of capital for our firm. As we saw in Chapter 7, this is difficult to calculate based on any theoretically grounded model. So we still have a problem in implementation. However, this can be alleviated by carrying out sensitivity analysis on the weighted average cost of capital. We will now look at how we can use this simplified economic profit model to value Ryman Healthcare. We will also look at how we can improve it by engaging with and forecasting a firm's economic and business realities.